TSS and BTE have joined forces.
Context,
Power.
edge.
The new paradigm of trading.
Imagine a stock suddenly jumping like 16% just because of a massive secret partnership with SpaceX.
Right.
Now, imagine the options market practically shouting about that exact same deal a full 7 days before it ever even hit the news.
Yeah, that's the holy grail, right?
Exactly. Today, we are taking a deep dive into a stack of data from August 2026 that basically proves the fundamental headlines you read, well, they don't always drive the stock market.
No, they really don't. More often than not, it's the hidden plumbing of options data that's really running the show.
Yeah, the plumbing. And for this deep dive, we have a really fascinating stack of sources to help us, open up that hood.
We do. We're looking at the daily spot gamma market notes, specifically from August 10th through the 12th of 2026.
Right. And we also bringing in a really crucial insight from a European market analysis, a Czech report called the Gamma Report.
Which has some incredible insights, by the way.
It really does. And our mission today is to understand how the biggest players in the market position their money right before major macroeconomic events.
Because in August 2026, the market is basically holding its breath.
Yeah. Everyone is waiting. You've got Wednesday's consumer price index, the CPI, which is, the ultimate gauge for inflation.
Right.
Then Thursday brings the producer price index, the PPI, and looming at the very end of the month is the massive Federal Reserve Symposium at Jackson Hole.
Yeah, and usually when people talk about these massive events, the conversation is, it's all about guessing the numbers. Will inflation be hot? Will it be cold? What is the Fed chair going to say?
But we are throwing that traditional playbook out the window today.
Completely.
We're not going to sit here and guess what the CPI number will be. We want to show you how options flow and dealer positioning actually dictate how the market is going to move.
Almost regardless what the actual news headline says, honestly.
Exactly. But to really grasp the mechanics of this, I think we first have to understand the overarching mood. Because the mood in August 2026, it's shifting.
It is like a profound transition.
The market is moving out of this period of absolute euphoria and hitting, well, a wall of macroeconomic reality.
Yeah, the spot gamma notes are waving some serious yellow flags about this transition.
What are they seeing?
Well, they point out that the whole AI narrative, which, had been the golden goose driving the market higher for months, it's losing its inspirational power.
Right, earnings season has passed.
Exactly, and the implied volatilities on these darling AI stocks, they're coming down. The speculative fever is finally breaking.
And the sources highlight that major corporations are actively taking advantage of that fading fever.
Oh, yeah, big time.
You have massive companies actively diluting their investors' upside. I mean, the notes specifically call out Google, Meta, and Intel issuing stock or debt to raise capital.
Which is such a classic signal. When corporations issue stock like that, they are essentially telling you they believe their stock prices might be as high as they're going to get for a while.
They're cashing in on the rich valuations before the window closes on them.
Exactly. They see the writing on the wall.
And all of this underlying anxiety is causing a very specific metric to flash in the data. The sources track something called TOR1M.
Yeah, the correlation metric.
Right, it's a correlation metric. The notes show this metric rising back to a critical level, specifically under 8.
And we really need to explain why that matters to the listener.
Go for it.
So, when TO1M rises, it basically means individual stocks are starting to move together in a herd.
Okay.
When the market is euphoric, stocks trade on their own individual merits. But when fear creeps in, everything starts dropping together.
Just a giant wave.
Right. And when everything moves as a herd, traders realize that picking individual, high-quality stocks, that won't save them from a market-wide drop.
So they typically rush to buy broad index insurance, like puts on the S&P 500.
Exactly. They need broader protection.
So a rising correlation metric is essentially a giant, we need to hedge alarm going off.
Yes, a blaring alarm.
But okay, let's unpack this. If the AI rocket fuel is burning out, and the data is screaming at traders to buy insurance ahead of these massive inflation reports, are they actually doing it?
This is where the data gets incredibly counterintuitive.
Okay.
Because they aren't. They aren't fully listening to the alarm yet.
Wow.
If we look at the skew positioning, which basically tells us where traders are willing to pay a premium for options call skew, is sitting at the very top of its 3-month range.
Okay, and the put skew?
Put skew is sitting at the absolute bottom.
Meaning Traders are still aggressively buying bets that the market goes up, and they are completely ignoring insurance against the market going down.
Precisely. They're completely exposed.
They essentially dumped their parachutes to make room for more rocket fuel.
That's exactly it. They chased the upside momentum of the AI trades so hard that they abandoned their downside hedges. The correlation metric is saying danger, but the actual money on the table shows they were flying entirely unprotected as we head into this massive inflation data drop.
Which makes what happened on Tuesday, August 11th, just absolutely mind-boggling.
Oh, Tuesday was wild.
Because Tuesday saw this brutal, panic-inducing sell-off right before the CPI print.
The panic was palpable. I mean, the sources track a metric called IJO.
HRI, right?
Right, IJO, which monitors options order flow in real time. And on the S&P 500, they registered a staggering negative $11 billion in delta notional flow.
Let me just jump in. For you listening, $11 billion in negative delta notional flow means massive aggressive downside pressure.
Huge pressure.
The notes explicitly say this was the largest negative reading in 30 days. It was driven by roughly $6 billion in put buying and $5 billion in call selling.
Which is just a tidal wave of negativity.
Yeah. To put that in perspective, an $11 billion negative delta wave hitting the market, it's like a massive cargo ship suddenly shifting all of its weight to one side.
Right, you expect the whole thing to capsize.
You expect a total collapse. But, and here is the crazy part, the market didn't collapse.
It didn't capsize at all. It fell, yes, but it hit this invisible buoyancy line and completely stabilized.
It stopped at an exact low of 7,717 on the S&P 500, which, miraculously, was Spot Gamma's pre-calculated implied one-day move low.
Down to the decimal.
It hit that mathematical boundary and just stopped dead.
And that invisible buoyancy line, it has a name in the options world.
Right.
It's called positive gamma.
Okay, I need you to explain this positive gamma thing because to a lot of people, it just seems like magic.
It's not magic, I promise. It's pure forced mechanics.
Walk us through it.
Okay, so around the 7,700 level on the S&P 500, there was a thick protective band of this positive gamma.
Okay.
Specifically, there were massive positions of 0 days to expiration, or 0 DTE, short puts sitting right between 7,600 and 7,750.
Wait, I'm stuck on something here. Let me play devil's advocate. If the market is dropping and options dealers are holding these massive put positions, they have to hedge themselves, right?
Absolutely, they do.
They have to short the futures market to protect their books. So shouldn't that massive wave of dealer selling make the market crash even harder?
Yeah.
How does it magically turn into a buoyant cushion?
That is the exact right question to ask, because what you are describing is what happens in a negative gamma environment. In negative gamma, dealer hedging accelerates the crash. But this was a positive gamma environment.
So what's the difference?
Here is the mechanism. As the market drops rapidly and actually hits that 7,750 to 7,700 zone, the traders who originally bought those puts, they are suddenly sitting on massive profits.
Oh, because the market fell into their strike zone.
Exactly. They hold winning lottery tickets that expire that exact same day.
Right. So what do?
They take their profits, they sell the puts back to close their positions.
Okay.
And when the traders close their positions, the options dealers, the market makers, they no longer have that massive risk on their books.
Oh, wow. I see it. The dealers suddenly don't need their hedges anymore.
Exactly. All those short futures the dealers sold to protect themselves on the way down, they suddenly have to buy them back to neutralize their books, and they have to buy them back aggressively.
That is wild. So the very act of the traders cashing out their profits at the bottom of the drop physically forces the giant market makers to suddenly buy the underlying market.
Yes.
And that forced buying is what arrests the fall.
Precisely. And the spot gamma notes show exactly this happening around 12:40 p.m. Eastern on that Tuesday.
It's a sudden reversal.
Yeah. Traders covered their puts, the IRO options flow reversed and started grinding higher, and the dealer hedging flows actively provided a floor for the market.
It's just incredible.
It proves that the mechanical supply and demand of the options market can at least temporarily override the fundamental fear of a macroeconomic event.
The fundamental news says panic and capsize, but the options math says buy the hedge back, and the math wins.
The math usually wins.
Which brings up a really interesting thought. We've seen how this giant mathematical buoyancy catches the entire cargo ship of the S&P 500.
Right.
But does this physics apply to the individual shipping containers? Like, if I'm holding a single tech stock getting battered by bad news, Are there invisible boundaries catching me too?
Absolutely. The individual stock charts from these days are textbook examples of these microdramas playing out. The exact same mechanics apply.
Take Intel, for example.
Perfect example.
The sources show Intel announcing a massive $15 billion stock offering. As we mentioned, that is huge dilution.
Massive.
And the stock falls 4% on the news. But when you look at the options chart, it wasn't a free fall.
No.
It hit an invisible ceiling on the way up and an invisible floor on the way down.
Yeah, Intel attempted to rally early in the day, but it perfectly rejected what Spot Gamma calls the key gamma strike at 100.
So it could break through.
Exactly. There was just too much options positioning there. The dealers were forced to sell into the rally, capping it. And then, as the stock fell on the bad dilution news, it didn't go into a death spiral. It stopped and closed right at a level called the hedge wall at 98.
Because at 98, there is a massive concentration of puts. And the exact same profit-taking and dealer buying mechanism we just talked about kicks in and creates a floor.
Exactly. The stock is essentially trapped by the options market's positioning.
It's like the stock is bouncing around inside a pinball machine. And the bumpers are these pre-calculated options levels.
That's a great way to look at it.
And you see the exact same thing with Tesla.
Oh, Tesla was a classic pinball day.
The notes mention Tesla showed relative strength on a very weak market day, but it was completely boxed in.
Yeah, it bounced perfectly between the 330 key gamma strike, which acted as the low of the day, and the 335 call wall, which acted as the absolute high.
And if you understand that pinball machine, I mean, it provides incredible opportunities.
It really does. The notes highlight that because Tesla was oscillating predictably between those two exact boundaries.
Traders knew exactly what to do.
Right. Traders playing the 340 weekly calls saw their positions double in value in just a single hour of trading.
That's insane.
They bought at the bottom bumper and sold at the top bumper.
But here's where this deep dive gets genuinely mind-blowing for me.
Okay, lay it on me.
Intel and Tesla are huge, heavily traded names. Everyone is watching them. But the sources highlight a smaller stock. Ticker symbol NN.
Ah, yes. The Flow Patrol scanner winner.
Right.
This might be the most revealing piece of data in the entire stack.
So get this. NN surges 16% on a single day. The catalyst. News breaks that they have backing from SpaceX.
Right.
They have a massive fundamental market-moving headline.
Huge.
But Spot Gamma's Flow Patrol option scanner didn't flag this on the day of the news. They flagged massive unusual buying in the NN18 strike calls 7 days before the news ever broke.
Yes. On July 31st, when the stock was trading around just $13, someone stepped in and bought thousands of speculative upside calls.
7 days before anyone in the public knew the word SpaceX was attached to this company. Somebody was aggressively buying these specific targeted options.
Yeah.
And because of that early positioning, by the time the news hit the Bloomberg terminals, the stock had gone up 38%.
And those options.
Those specific $18 calls jumped from 90 cents to $3. That's a 233% gain.
It is a stunning visual of information asymmetry.
Truly.
And the sources are explicit about this, too. It is not an isolated incident. They mention we've seen this exact pattern earlier in the year with companies like Netflix and Qualcomm.
It's like seeing the shadow of the monster before it actually turns the corner. You just have to know how to look at the shadows.
That's exactly what it is. The takeaway for you listening is that options order flow frequently acts as an early warning system.
Right.
Someone, somewhere, always knows. And before the headline hits the public, the footprint of that knowledge physically manifests in the options market.
Wow. Okay, so we've seen how Gamma creates a buoyant floor for the S&P 500.
Yep.
We've seen how it traps single stocks like Intel and Tesla in a pinball machine.
Right.
And we've seen how options flow predicts fundamental news with NN. So how are the professionals actually taking all these puzzle pieces and setting up for the massive consumer price index drop on Wednesday? What is the actual CPI playbook?
Well, the sources outline a very specific mathematical matrix for the S&P 500 based on all this positioning.
Okay, what are the numbers?
They have resistance mapped out at 7,800. And they have a critical line in the sand that they call it the risk pivot at exactly 7,680.
And the strategy they outline is entirely dependent on those levels.
It's brilliantly binary.
How so?
If the inflation data comes in hot, meaning inflation is still high and the Fed might have to stay aggressive, and the S&P 500 breaks below that 7,680 risk pivot, the playbook says to press shorts.
That means aggressive selling.
Yes.
But why there? Why is 7,680 the cliff?
Because if we break below 7,680, we fall completely out of that protective positive gamma band we talked about earlier.
Oh, I see.
There are no more huge concentrations of puts. There are no more dealers forced to buy the dip to monetize their hedges. The buoyancy is gone. It becomes a free fall.
Wow. But what if the data is benign? What if inflation is cooling off like everyone hopes?
If the data is benign, the sources note a fascinating setup on the upside. Because of how the options are currently positioned, there is a total lack of resistance above the market.
Really?
Yeah, there are no heavy dealer positions acting as ceilings, so if the market rallies, there are no bumpers in the pinball machine to slow it down.
It just goes.
It becomes a sharp, swift vacuum move straight up to 7,800.
And if the producer price index data the next day is also calm, the notes say all eyes shift to the massive 8,000 level for the August options expiration.
Exactly. And to play that upside vacuum, the professionals are holding what are called short-dated call flies.
Called butterflies.
Right.
For the listener, that's a very specific defined risk option structure. It basically allows a trader to capture a massive payout if the market pins at a specific higher strike, like 7,800 or 8,000. And they can do that without risking too much capital if the trade goes wrong.
Which brings us to, honestly, the most paradoxical piece of data in this entire stack.
Okay, what is it?
We mentioned earlier that traders dumped their parachutes to chase the AI rally.
Right.
The spot gamma notes quantify this. They point out that SPY 1-month 25 delta puts have an implied volatility near 14%.
Okay, hold on. Let's blend that into English for the listener.
Sure.
They look at the standard insurance policies on the market. Specifically, the 1-month 25 delta puts on the SPY. Basically, the standard options contract that pays out if the broader market drops 5%.
Right, the baseline parachute.
And the implied volatility is hovering near 14%, meaning the premium, the actual cash cost you have to pay to buy that insurance,
is the absolute cheapest it has been for the entire year of 2026.
That is wild. The market is clearly nervous.
Yeah.
We have a massive CPI print. We have PPI. And we still have the giant Federal Reserve symposium at Jackson Hole looming at the end of the month, where the Fed chair could literally say anything.
Anything at all.
The correlation metric is flashing a massive warning to hedge. But the actual cost of buying downside insurance is the cheapest it has been all year.
Yep.
And everyone is crowded on one side of the boat, betting on an upside vacuum to 8,000.
It raises an incredibly important question about the psychology of the market right now.
Seriously?
There's a brilliant insight in this stack from the European market analysis, the Gamma report.
What do they say?
The author makes a profound observation about this exact dynamic. I'll translate the core thesis here. It says, this is not a weak market. It is a strong market with too cheaply priced risk.
Too cheaply priced risk. Okay, that gives me chills, honestly.
It should. It encapsulates the danger perfectly. A strong market is generally a very good thing.
Sure, yeah.
But when risk is priced too cheaply, it means absolute complacency has set in.
Right, people get lazy.
Exactly. It means the market is severely underpricing the risk of what might happen at Jackson Hole, or what a hot CPI print could do. Everyone is standing on one side of the boat, assuming the weather will be fine.
So no one is wearing a life jacket.
Nobody.
And if an unexpected gust of wind comes, say, a surprisingly bad inflation number, the reaction isn't just a minor correction.
Yeah.
Then at all, because no one owns insurance, the sudden rush to buy protection all at once triggers a violent outsized reaction.
Exactly. Because when everyone rushes to buy those cheap puts at the exact same time, the options dealers have to suddenly short the futures market aggressively to hedge that massive influx of new risk.
Which flips that invisible buoyancy line into a trapdoor.
You got it. The mechanics that save the market on a slow day are the exact same mechanics that accelerate the crash on a panic day.
Man. By taking this deep dive today, you're no longer just sitting there reacting to a red or green headline flashing on a financial news network.
No, you see the whole picture?
You actually see the underlying matrix now. You see why 7,680 is a cliff and why 7,800 is a vacuum.
Yep.
You see the invisible 7,700 gamma cushions catching the cargo ship. You understand how the smart money leaves literal footprints in the data a full week before a SpaceX deal is announced.
It changes everything.
It really does. You understand how the market will mechanically, mathematically react to the news. not just fundamentally.
You understand the plumbing.
Yeah.
Once you see the plumbing, I mean, you really can't unsee it.
Exactly. And as we wrap up this look at August 2026, I want to leave you with a thought to mull over on your own.
Oh, this is a good one.
If the options market can predict massive corporate partnerships a full week in advance,
Yeah.
and if dealer hedging requirements can magically arrest an $11 billion market sell-off right at a pre-calculated mathematical boundary, who is actually driving the stock market? Is it the fundamental investors, carefully analyzing balance sheets and buying pieces of companies they believe in? Or is it the polled, calculated algorithms of options market makers, entirely dictating the physical boundaries of reality?
It makes you wonder.
Something to think about the next time you look at the ticker tape.